without further ado, it's with great pleasure that I would like to introduce you to Georg Kell. Georg, his background is one of economics and engineering, but he actually never took up either in earnest, but found himself heavily involved in the United Nations all the way from 1987. He's got probably the accolade of having worked with Kofi Annan, which is no mean feat. He has been with the UN since 1987. He's actually the executive director of the United Nations Global Compact program, an initiative of which he was the founding director, and stayed with until, I think, 2016, at which point he was nominated and voted as one of the world's leading business ethicists. So again, another big accolade to have. He is now the CEO of Arabesque Partners, and it's with great pleasure that I introduce you to Georg Kell. Over to you, Georg.
Thank you, Andreas. Thank you for having me. It's a real pleasure, honor. Hello, everybody. Good evening. Hello from New York. The conversation today is about the rise of sustainable investing. So what I want to do is give a brief historical overview, then point out ongoing issues, how finance is changing or not changing. And then in my concluding section, I will try to look a little bit ahead and guess a little bit about the future, including in the light of current developments and the war in Europe. So it's always good to begin at the beginning. Sustainable investing is nothing new, arguably. Ethical and responsible investing is probably as old as the history of finances. Often it was used as exclusionary criteria. Think of anti-slavery movement, boycott South Africa, and many more initiatives. Faith-based organizations have long codified this behavior as ethical investing, namely often excluding in particular tobacco, alcohol, weapons, and other issues not compatible with their beliefs. What really has changed in the modern landscape of sustainable finance or investing is that a link has been discovered between sustainability and profitability. And I want to go back a little bit where this all started, in my view at least. I was lucky enough under Kofi Annan when we launched the Global Compact, then also to think through how can we engage the world of finance. And Kofi Annan signed invitation letters to heads of pension funds in 2003, inviting them to a working group with the title, "Who Cares Wins." And after 1 year of work, about 15, 20 CEOs of pension funds, mostly asset owners, came up with 6 principles and the term ESG, and basically argued that in today's world, it is increasingly necessary for prudent investors to also take into consideration and increasingly integrate environmental, social, and governance issues. Why? Because these issues affect the bottom line. In other words, the material relevance of sustainability was discovered. Now, that sounded all great, and a year later, we had the great privilege launching the Principles for Responsible Investment at the New York Stock Exchange, now a London-based global organization with tens of trillions of dollars of assets aligned with the roadmap of ESG integration. The basic roadmap meant learning about these factors, trying to measure them, and finding a way to take them into consideration when doing analysis and then also influencing decision-making. In reality, not much happened in the subsequent years. Remember, we had then the financial crisis. There was another big issue, pressing issue, monetary policies, easy money came, and the battle was really about regulation versus too much regulation. Something fundamentally changed then in 2013-14, when the first studies popped up, including one by the firm I'm associated with now with Oxford University and Arabesque, which established a correlation, a relationship between the ability to integrate ESG factors into your decision-making on the one hand and long-term valuation on the other. And a number of such meta-studies then came out from all over the place. And all of a sudden, Wall Street, London City, Hong Kong, and many other places around the world were interested in this ESG. And that's where the modern movement, in my view, really took off, as evidence appeared that there is a relationship between ESG factor integration on the one hand and long-term returns and valuations, profitability on the other. Today, by credible estimates, more than 1/3 of globally managed assets under management, professionally managed, integrate some notion of ESG factors in their analysis, and many predict that within a few years, that figure will go up to more than 50%. Now, that's kind of a brief sweep on history. Now, what does all this mean? In the meantime, there is a backlash against ESG investing, sustainable finance. Critics argue that it's all greenwashing. It's not real change. It doesn't really change the fundamental issues we are facing, such as climate change. And by the way, the data which it is using, the ratings, the ESG ratings, are useless, they're backwards looking, and they're not comparable. Now, in all of these critics, there's something true, but if you analyze the main arguments behind the critic, you basically have two arguments there. One is based on the efficient market hypothesis, whose proponents argue that prices integrate all relevant information anyway. So if you lay an ESG lens on top of that, you only distort the reality. That's one point of criticism. The other one really at its core is that it's not the responsibility of markets to take on board non-traditional financial issues unless regulated. That's kind of a Milton Friedman soft version argument, arguing basically it's the business of business to be as profitable and to maximize shareholder value, full stop. So if you come with an ESG agenda, you impose something differently. The counter-argument to these counter-arguments are, however, very compelling. The first one, obviously, is markets are far from perfect. We know this from history. And as Nick Stern famously said, for example, the non-inclusion of emissions in financial accounting is arguably the biggest market failure of all times. In other words, markets are not responding in time to what is ahead of us. They only digest what has happened already. Secondly, one can also argue that yes, ESG integration can lead to bubbles, for example, too many investors investing in wind companies or renewable energy companies and overvalue them. But the counter-argument there clearly is any major transformation is never linear. It is bubbles are almost necessary. Think of the internet introduction and the internet bubble in 2000, and this was not the end, it was just the beginning. In a similar vein, you can argue that the ESG growth is just pausing and reorienting itself. And I have two very strong arguments, I believe, to make that case. First, increasingly, we do see how regulators around the world are taking this agenda seriously and actually making the ESG agenda, in particular carbon disclosure, increasingly a requirement for the license to operate. In other words, some parts of the environmental agenda are becoming part of the regulatory agenda. And once that happens, then obviously market prices will adjust massively one way or the other. The second one is technological change. It is accelerating and it is not slowing down. And technological change plays a major role in these transformations. Not only does it enable the transparency on the measurement on the data side, but increasingly in itself, technology is also the solution we're looking for in the bigger transformation picture. And thirdly, the third argument actually why ESG rise is irreversible is the fact that the human impact on the natural environment is not slowing down, and the repercussions, the feedback from the natural environment on our very foundations is bound to increase. That means we haven't reached yet an end point of measurement or change. As a matter of fact, it keeps on going, outpacing our pricing ability, outpacing our regulatory response capacity, even outpacing our social norms ability to adapt. So with these big drivers in place, and they are by and large irreversible, certainly technological changes, certainly the natural boundary agenda is, whether it's loss of biodiversity, whether it's increased concentration of greenhouse gases in the atmosphere, or whether it's freshwater access limitations or soil degradation and deforestation. These issues are not only here to stay, they will become ever more powerful, and they will force us to adjust our pricing and our valuation perceptions. So you can interpret the ESG approach is an effort to build a bridge into the future. Over time, I believe, and I share the view, that ESG investing will ultimately disappear because it will become the new normal. There's just no way around. Our pricing structure, our preference systems will have to adapt over time. We still have a long way to go there. We see it in failed efforts, for example, to price emissions appropriately. We see it in failed efforts largely of lifestyle changes or energy transformation questions. We still have a long way to go. In a way, one can argue the real journey is only starting now. What we have done the past 2 decades or even longer was just preparing for that ground. Finance is responding now. I think it's a phenomenally good news. It's very good news that finance is now integrating this factor into their analysis. By doing so, finance is channeling some of its allocation in a more preferential manner to solutions and a little bit away from the problems. We did write recently a book on this called Sustainable Investing. I don't want to make too much advertisement, but we have 15 contributions there from 15 authorities, and they shine different perspectives on this transformation. At the theoretical level, you can argue the challenge is to really learn fresh again on valuation and to integrate what used to be non-financial into finance. And that ain't easy for many economists and analysts. This means changing their valuation schemes, changing their mindsets, and coming up with new scorings and new valuations systems. At the corporate level, the change is very, very deep too, and I can speak to that in a few minutes because it exemplifies that this agenda is not a fashion trend. It's something really systemic, fundamental. It affects basically all corporations, large and small, across all sectors. In a stylized fashion, one can argue the industrial era is coming to an end, and we are searching for a new economic model. And this transition is in full swing now. And the ESG movement, the sustainable finance movement, is looking to get a handle on that, how to evaluate that. Let me give you a few examples. In the old successful industrial era model, the strategy was largely about scale and scope. Scale brought lower costs, scope the ability to expand. Organizational structures were largely hierarchical, top-down, departmental-wise. Human resources were seen as a cost factor. Labor costs, major classic issue in industrial economics. Natural resources were largely either a cost factor or an externality. You bought raw material and inputs at the lowest possible price. You transformed it, you processed it, and you created something new out of it. It was just an input. Policy approaches by corporates towards regulators was largely compliance-oriented. You wanted to meet the regulations at the lowest possible cost. And when you got caught in some misbehavior, if the fines were lower than the cost savings, so be it. This was called compliance optimization. And then, of course, energy supply was based on fossil fuel. In the new economic thinking, we have a totally different orientation. Strategy, scale, and scope is now replaced largely with purpose, speed, and agility. The platform economy is disrupting one industry after the other. The migration into the cloud is accelerating. AI is taking on more and more decision-making. It's a whole new world. It's not top-down. It requires on the human resource side to attract the best talents and to motivate them with a shared purpose, a whole new agenda. The natural resource side, going to zero carbon, increasingly is a competitive advantage. It's the ability to produce, to create value while doing as little negative footprint as possible. And that is increasingly necessary, not only for your license to operate, but also for the consumer preferences, which increasingly are going this way. On the policy side, more and more progressive companies now advocate for the right policy frameworks rather than opposing regulation on ideological grounds, arguing we have to phase out the old incentives that favor fossil fuels, for example, and we have to move into a new world order where emissions are priced accordingly. So energy supply of the future is clean electricity. There's no way around. This transformation is in full swing. So, and this kind of paradigm shift, which is really systemic and big, is at the core of the transformation that sustainable finance tries to get a hold of. And then, of course, the question is, how do you measure that? How do you feed the relevant information into your analytical assessments? And as of today, that landscape of ESG data or ratings is indeed, how should I say, almost a problem. It's certainly imperfect. Some recent studies, such as one by the MIT, talk about the aggregate confusion. Why? Because the ratings are backward-looking. There are about 600 frameworks out there for different industries, for different regions. You cannot compare the data. So as an investor, what do? You either aggregate the data and you try to outguess what's the right answer. You may get it right or you may get it wrong, or you're just frustrated and you look for alternative sources. Now, there's a breakthrough happening. It's already well underway. Increasingly, ESG data is made publicly available. My own firm, Arabesk, launched the ESG book, which does precisely that. And it shows raw data. It shows the corporate disclosed data, and it complements it, obviously, with secondary data from other sources. And with that new notion of ESG data as a public good, I think this data barrier and the challenges will be overcome. Supported by smart analytics, empowered by technology, increasingly these huge amounts of data can indeed be interpreted in a relevant way that speaks to the materiality of the decision making. And thanks to technology and also thanks to regulators who increasingly require the disclosure of such data, I do believe that this data barrier increasingly is no longer a problem. The situation is improving month by month, as a matter of fact. That's one big stumbling block ahead. I think the industry is currently working on, and there is good progress, and time is on the side of the solutions, no doubt. The second big problem is harder to circumvent, and I don't have a solution, but the problem is well known. It's what Mark Carney called the tragedy of the horizon, meaning we are very short-term in our anticipation, and we may well understand long-term problems, in theory, but we find it extremely difficult to discount them at the right rate for our current decision making. There's a bias for the near term, for the short term. In short, it still makes economic sense to burn the globe. There's lots of money to be made. Although we know that this is not sustainable. If one were to apply a long-term analysis, then obviously one would probably not undertake many of such activities, including cutting redwood from precious forests and other things. That's a real problem, the short term and the long term. That's where regulation has to come in. That's where I believe the valuation is lagging behind and not fast enough catching up. It's a dilemma that increasingly, however, will be solved by the fact that those who play the short-term game are actually acutely aware or increasingly are aware that they may actually get totally burned. We talk of stranded assets, for example, when as of a sudden societies, regulators will denounce such activities and switch abruptly into other domains. So the risk spectrum is increasing enormously for short-term behavior that ignores ESG issues. There's no perfect solution yet, but I again believe time is on our side. And I had a brief chat with Andreas upfront, and it reminds me, nobody obviously can look into the future, but in all likelihood, we will face increasingly external shocks that will accelerate that transformation further. So to sum up that part, ESG, sustainable investing, is becoming mainstream. It's a transient phenomena because at some point it will become the new normal. The ways, the barriers that are still out there, insufficient, not quality, good enough data will be overcome. The short-term, long-term dilemma is not solved, but I think time is on our side. Regulators, consumers all play a role in this. So I think we're moving in this direction. I want to reflect now a little bit on what external shocks mean and how the new world order may affect this agenda. Will sustainable finance thrive in a fragmenting world where systems rivalry between, say, the US and China will increasingly dominate economic activities? Will market responses, as I outlined them, also flourish in a world where governments are back, the state is back, and increasingly uses the private sector also for geopolitical purposes? Will the ramifications of the war in Europe disrupt this agenda, since many countries are now forced to beef up coal again and shift their attention to crisis management? The answer is obviously nobody knows for sure, and I hope we will not waste this crisis as we wasted the COVID crisis, where most of the funding, by some estimates, $19 trillion in the OECD world, did not support this big transformation, but rather was just handed out to keep everybody happy and quiet. The risk is now, again, with the war in Europe, that politicians are overly concerned with pacifying existing demands. There is a risk. But on the other hand, there's this real loud awakening call that energy security is a priority, and that gives a whole new momentum to the energy transformation. And that is a good thing, and that will happen. It will also give an impetus to digitalization and AI solutions, because supply chain vulnerability increasingly means there's a premium on circular economy, on smart recycling, and creating material flows that come back and not just end up in the waste dump. So there's some good news there, that natural environment and natural asset issues will clearly get an uplift out of national security concerns. On the downside is arguably the argument that a fragmenting world where power politics increasingly define about license to operate, that market-led solutions will be slowed down and we will lose on efficiencies and productivity that will increase poverty around the world. Already, COVID has done a huge blow to development. The war in Europe is adding another blow on inflation and so forth. So there's these risks out there which are increasingly becoming bigger in their nature and a bit threatening at some level. But nevertheless, the ESG agenda, sustainable finance, is here to stay. It's a very good thing. It means finance is now aligned more with corporate changes. It's aligned more with smart policy changes that are aimed to creating more sustainable markets, both on environmental, but also on the social side. I didn't talk much about it, but much of what I argued on the environmental front also applies to the social front. So I remain optimistic on that front. And so long as peace will prevail in this world, so long as humanity will not kill each other again, I think we stand a fair chance to reinvent economic systems that will do far less damage to our natural environment, that will be friendlier to people, will reduce ultimately also some of the social divides which we have been facing increasingly. And also it will open up whole new opportunities for exciting business activities. So I try to stay optimistic on that front. I think it is important that whenever a crisis hits us, we increasingly think also long term, and we think through how can we harvest the lessons learned from crisis response to reinforce the structural systems changes we all seem to want to, and we all agree we want to accomplish. That is a challenge because politics often is focused only on one issue, and I find it very difficult to work at two levels at the same time. But this ability to use short-term adjustments and changes to at the same time build long-term solutions is key if we want to succeed in our agenda. On the climate front, I'm less optimistic, I must admit, having been involved there since 92. I think we will increasingly be forced to adjust. And the big question really is, at what point will the climate impacts be big enough to cause system responses that are appropriate? So far, we haven't seen that, despite huge fires and flooding and other natural disasters which have a climate dimension to it. Despite that, it hasn't really triggered the policy response one would actually expect from rational decision makers. But I have no doubt that over time, nature will force our hand. The question is when and where and how. Sustainable investing can and should play an important part on the solution side in creating the new economy. It should succeed as fast as possible. I should conclude just also with an optimistic note that also on the regulatory and standard setting side, there's a whole new momentum now to create more globally minimum standards. The IFRS is a serious effort to accomplish that on the private sector side. In the US here, the SEC just put out a proposal which has chances of succeeding by the end of the year, which will comply then all companies to disclose climate, carbon, greenhouse gas emissions. The European Union is way on its way with the taxonomy and other measures to push more from the regulatory side. So there are big movements going on in this direction, supporting the sustainable finance evolution. Over time, finance will come fully to grips with that. And I do believe this is not years into the future. This is few years into the future. Thank you very much.
Thank you very much indeed, Georg. That's a very interesting exploration of sustainable investing. over a number of decades. And what is particularly helpful is that it covers also the potential future trajectories of sustainable investing. So it would be really helpful if we could now unmute ourselves and potentially show our screen and give you a big round of applause for all the information you've provided on sustainable investing. So thank you very much, Georg.
That's nice. Thank you. I wish I could be with you in person. It's after 2 years, I still find it odd to talk into an abstract camera and not seeing the people, but maybe another time.
Well, and of course, you're reunited with an acquaintance of yours tonight, Robin Aram, who's joining us on Zoom today. I don't think you've met each other for the last 20 years, so at least something positive has come out of a virtual Zoom session,
right? Which
is great. But we would love to see you here. You know, if you're ever in the UK, Georg, please come along and we can invite you to the Bath Royal once again. But we're now coming to the Q&A session, so there's quite a few things in the chat room. But is there anybody who wants to actually ask a question here live before I go to the questions in the chat room? Anybody, or should we start in the chat room first? No, I'm happily go to the chat room then. If people want to sort of wait a thing, I've put a question in initially to get the conversation going in the chat room, and that is, as climate change becomes more and more tangible and urgent, what will this mean for ESG?
In all likelihood, the requirement to disclose emissions, what they call Scope 1 and Scope 2, which are the direct emissions of companies, and Scope 3, upstream and downstream with suppliers and consumers when products are in use, will increasingly become mandatory. And that's in the making. The fact that this hasn't happened yet, in my view, is a little bit of a scandal because it's the most obvious thing you want to know when you deal with emissions. You want to know who emits how much and how is the balance sheet changing over time. But unfortunately, as of today, there's data available. My own firm, Arabesque, has a temperature score. We cover, I think, 4,000 companies or 5,000, but many more don't disclose yet, including some of the biggest companies, listed companies in the world. I think it's a scandal in the year 2020 that carbon reduction, in my view, is the currency of the future. The ability to reduce carbon is becoming essential, and to not have a standard for measurement and disclosure, in my view, is a scandal. Luckily, this is happening right now. I mentioned the SEC proposal that is being opposed by some in this country, in the US, but in all likelihood it will fly. The European Commission goes in similar tracks. They're actually more complex as usual. They make a bureaucratic monster out of it, to be quite honest. American pragmatism says the most important things first. Okay, climate change is serious, so let's measure greenhouse gas emissions. So the SEC proposal is very much focused on greenhouse gas disclosure. And if that goes through, then of next year, all listed companies in the US will be required to measure their emissions, at least in Scope 1 and Scope 2. And there are inducements for Scope 3 as well. Right. That, I think, is overdue. It's overdue. It should have happened 10 years ago already, frankly.
Okay. Thank you for that. And by the way, I'm sure most of you will have seen it, but I've put the actual link to the book, Sustainable Investing, A Path to a New Horizon, in the chat room. So, you know, if you're interested, then obviously you've got the link for that. Duncan, you asked a question. Do you want to ask it yourself, or do you want me to read it out in the chat room?
Well, I'll ask it if people can hear me.
Yeah. Yes.
Okay. No, basically, has the Ukraine international crisis made arms manufacturing and its export sustainable? And is this fair? I'm thinking in particular of an article you wrote maybe a couple of years back where you said that arms, nobody needs a prize for prophecy, but you said that arms dealing was actually turning unsustainable. Unfortunately, it's changed.
I must confess that my whole life got upset with the invasion. I've been a pacifist in the good old German post-World War II tradition. After having tried to come to grips with the past, which took me decades, and I felt ashamed being a German for many years, until in the 90s when Germany faced the past and then embraced Wiedergutmachung and basically made pacifism a national ideology. I felt very good about it. Now comes the rude awakening, reminding us that imperial mindsets are still in charge of state power, something we all thought was a thing of the past. After all, wealth creation today does no longer depend on occupying country or agricultural land. So the world is now forced to come to, or at least the part where I came from, has to rethink now the meaning of self-defense, of arms, and then the divisions come up. What is a defensive arm and what is not a defensive arm? The lines are blurring. I wrote in an op-ed piece recently that investors now have to rethink not to exclude arms if they serve the purpose of self-defense, ? I learned yesterday that in the Nordic world of all, already half the pension funds have actually internalized that. They now include arms manufacturers. So it's a dilemma. At the same time, the global statistics on arms trade are really scary because exports of arms have been increasing over the last 15 years everywhere. It's a significant share of exports for some countries, including the one I live in. It's the number one exporter. International regulations on illicit arms trade basically were blocked by the lobby group. I know that firsthand, very sad. Hopefully the non-proliferation treaty on the nuclear side will be revived at some point, but even there, it has been lingering. There hasn't been much progress, not since President Trump took over, and not much since then because the confrontations have significantly increased. So, in other words, on the security front, the situation has clearly deteriorated, clearly. And many people now argue, does this feel like the 70s where stagflation is about to come? No. Others would argue it feels like 1914 when the first wave of globalization came to a crashing end. I hope that is not the case. And obviously, the most important thing now is that Ukraine doesn't become a big war theater. The risk is clearly still there. And the hope is also that imperial mindsets around the world are not getting inspired now by the behavior of Putin. So I'm quite concerned, and my own world picture has totally been put upside down, I must confess. It's very sad. The reality is to face the realities.
Yes, we certainly seem to be living with the Chinese curse. May you live in interesting times. That's definitely true. Bob asked a question as well. I assume, Bob, that's you, Robin. Do you want to ask the question yourself, or shall I read it out from the chat room? I don't think Robin can hear us, but Bob is asking the question, what is the attitude of the high environmental carbon producers, the USA, Russia, China, India, to the Western-generated ideas on ESG?
Well, mixed at best. At the bottom, very suspicious, because behind it lies the likelihood that at some point those who are committed to reducing emissions will introduce tariffs on imports that are high carbon greenhouse gas intensive. It's the only way to level the playing field if one wants to avoid that major industries migrate into other places. So they're watching this with suspicion. But in Asia, I'm proud to say the ESG agenda is doing quite well in the ASEAN region. Singapore is one of the hubs for that, for example. It's booming there. We have an office there too. And people are very forward-looking also on the decarbonization front. The big unknown, obviously, is China. I mean, they promised to become carbon neutral by 2060, but in the meantime, they increase coal-fired power generation massively. And the old saying was always, if China doesn't play along on the climate front, then whatever the rest of the world does is almost meaningless, because they are so dominant now in terms of emission shares in the world. So we have a real challenge there, and I applaud the envoy of the US, Kerry, for trying to build a partnership with China on climate. This partnership, which was launched in Glasgow at the COP. But giving that now life would be the challenge. It's one of the few areas where the big superpowers, in theory, should have an interest to collaborate, because climate change is a common enemy. It doesn't respect national boundaries. But China still argues that the Western world, which has accumulated the emissions in the past, has a historical responsibility to first demonstrate major reductions. And their CO2 per capita footprint is still only half as high as the average American footprint is, by the way. It's at the same level as European average today. So that's kind of the argument, and they're playing with it. And nobody knows for sure at which point they will become more serious. At this point, sadly enough, they're expanding massively coal-fired power plants. India, very similar arguments. There's a new movement now starting. It's an old movement called the non-aligned. You will recall this from the Cold War. There was a group of influential countries, India, Indonesia, they're the founders of that movement. They called themselves non-aligned. They didn't want to be part in the Cold War of either side. And that movement has been reinvigorated right now. And they take a similar position that first, the rich countries have to demonstrate that life is possible, low carbon. And secondly, that our transformation should be financially supported because of historical obligations. And you will recall the big issues. One of them is the 100 billions that were promised at the Paris meeting that never really materialized either. So we have a real dilemma there too, a deficit. It's fragmented currently, and there's skepticism, but all those players who are linked to the global market play along. So I should make that very clear. In all these emerging markets where you have aspiring companies that want to become world champions, they always aspire towards the highest standard. And that's the beauty of global integration. I still believe in it, in openness, because if you want to be a winner, you want to be a winner everywhere. If you're an Indian company, you want to be able to compete in the US or in the Netherlands. And in order to compete there, you need to be able to perform on the highest level of performance standards.
Yeah. Okay. Thank you for that. Right. Do we want to? Does anybody have any question before I go back to the chat room? Because this chat room is still going strong. But if anybody here on video wants to ask a question, please feel free to do so.
I saw a question over video here. The role of taxes, and is that correct?
Yeah, we've got quite a few. There's one question. I'll go back to this question in the chat room, and then maybe people will come in. What will be the catalyst to move investment from short-term to long-term?
That's, if I had an answer to that question, I would be a rich person, first of all. But I would also have one of the biggest solutions to a basic human dilemma. I don't see an easy solution, frankly. Improved governance helps. It helps to bring these issues into the boardrooms. Increasingly, CFOs, chief financial officers, are really sensitized on these issues because they understand it has financial implications. That's good news. But there's plenty of hedge funds and private capital that will continue to exploit short-term advantages under any, so long as it's legally permitted. So I don't see an immediate solution there unless regulatory schemes come in stronger. For example, in the area of deforestation, there's just no way around. We need regulation. Otherwise, you cannot stop cutting down of precious woods. People see huge opportunities in that, and prices are extremely high, so it's extremely tempting. So you need regulatory protection on that front. But on the basic dilemma, long-term, short-term, I don't have an answer. I'm really sorry for that.
No, that's quite all right. As you said, if you had the answer, I would like to know, because both of us would be extremely rich. Trevor, you raised your hand, so over to you.
I did raise my hand, yes. I thought you'd have a question on it. Georg, thank you very much for such an excellent presentation. Lots to think about there. I'm very pleased that you're optimistic about a new economic system evolving, which is going to be beneficial for everybody. I'm pleased that you're very optimistic. Are there limitations, though, caused by how the financial system works at the present time? I'm thinking about the stock exchanges and the money markets. So does that limit how far we can go? We said you go from 30% to 50% ESG implementation. And to do with that, this needs a fundamental change in the way people think. Here's my question. Are we doing enough in business schools and other schools to educate the future generation to think in this way? Or will it take much longer because they educate, they come into the system, and it's the same old system, just like the question that was just asked there. Are we doing enough, do you feel, in your contact in those business schools particularly?
No, by far not. I'm shocked, to be frank. I speak quite a lot at business schools, and I also had the privilege of creating a business school global initiative called Principles for Responsible Management Education, PRIME. And it is shocking to realize that the textbooks that are widely used still reflect the thinking of the 60s, 70s, 80s, at best the 90s. It's shocking. So young people are still trained to maximize, optimize in a black box mindset, when in reality, it's the interrelationships and the changes that should now be understood and comprehended. I'm shocked. No, we are not doing enough. And the same then you discover when you talk with corporations at senior level, including at board level, and you realize that still the old mindsets are giving direction there. And they are experts in this mindset thinking of linear optimization. Yeah? So we are falling short everywhere, actually, and it starts with education. Yes, I know there are many good movements now ongoing, and the UK is arguably on the leading edge there. We get a lot of the young people from Cambridge, for example. So it's a good crowd of next generation forthcoming. But other than that, around the world, we are shockingly slow in adapting to the new environment.
Yeah, yeah. Can't hear you, Andreas.
No, that's fine. Georg and I had that conversation earlier. I mean, in terms of neuroscience and psychology, we seem to be determined to only focus and react to things that are in front of us right now. We seem to be very bad at actually reacting to potential future events, and I think that is something that definitely would have to change. Now, I've got another question in the chat room by David Greenwood. David, do you want to unmute and ask the question yourself, or do you want me to ask it on your behalf? There's David. Hi, David. You're still on mute. We can't hear you. Well, I think he's outside, so I'll ask the question on his behalf. Any thoughts on just transition? It's good to decarbonize, but how to ensure it is inclusive transition that does not destabilize society and create greater inequality?
Yeah, I mentioned before the financial obligations that the world committed in Paris and has not delivered. I think shame, shame, shame. Yeah? So that is just one aspect to it. The positive side, I would argue, is technological change and what some call leapfrogging. There's ample evidence now around the world that, say, decentralized power generation systems are competitive, that you can actually tackle basic needs much easier. I learned recently that in Pakistan, for example, the renewable energy sector is booming like nowhere else in the world. I also know from various African countries how technological solutions help local societies. And the Economist has long made the argument, and I think it's the right one, that the mobile telephone has done more for development than all the official development assistance taken together. So, because it allows for so many improvements. So there's hope that on the technology side, if that is fostered faster, one can actually progress much faster. And many countries now understand that there's no need to replicate the old industrialization pathway, first build steel plants, then cement plants, heavy industries, and then you move into but on social justice, I think the world is also failing to a large extent, and it's failing also because multilateralism is failing. In the UN, we have a total split now where the US and China are using the Security Council basically as a stage to make their own domestic agenda against the other. And that has ramifications for everything else. Yeah. That means collaboration is just not in anymore. Multilateralism, sadly, is rapidly on a retreat. It's a whole new world now. I can tell you one episode I could historically witness, if you allow me, because I always tell that story. When I was with Kofi Annan, one day there was a package coming in, a letter from Tony Blair, it was before Iraq, to Kofi, saying, my people tell me the attached is very interesting. If you like the idea, let me know, I'll support you. So I opened 30 pages of fine print. It was the outline of what is now the Global Fund for Health, the biggest multilateral creation in the last 20 years. And of course, Kofi Annan replied, this is great, the fight against AIDS then. But the point is really, in those days, Tony Blair, highly respected world leader before Iraq, approached Secretary General with a new idea for a global solution and offering him to support him all the way if he likes it. This is unthinkable today. No head of state will bring big solutions to the UN, sadly. They will use it bilaterally to compete with their rivals. Yeah. So the times are changing. We are in a near Cold War situation again, sadly. And we have to find a way out. And I like to believe that ultimately climate change will force our hand and it will force us to collaborate again, because then we have a common enemy. The world seems to need an enemy. Don't ask me why.
Yeah, it's a shame, isn't it, Georg, that the humanity needs a burning platform before it comes together to do something. It's quite something. Right, the next question is from Duncan Cameron. Duncan, you've actually already unmuted and the camera on. Do you want to ask the question yourself?
Yeah. Yes. Yes, I was interested. Yes, hi, Gail. I was interested in what you had to say with reference to this economic model, how it's going to have to be reinvented. But I'm just wondering how radical you might think that could be. I mean, I'm just wondering what scope is there for economies that are totally focused on growth in the future? I mean, I'm not even sure whether that can stand the test of time. And so at the moment, it looks like with a combination of regulatory conditions and simple market forces, we just slot a set of new ESG parameters into the existing economic model and it will solve itself. But I don't know, my sense is it needs to be something more radical than that.
Yeah, and you may well be right. I alluded to the fact that nature will force our hand. External shocks will force us to make more radical changes. In my view, valuations and values have always been at the core of human behavior and market behavior. And the value system has to change totally. I fully agree. I mean, we need new paradigms of what does it mean to be healthy, happy, and what do you really need to realize your dreams. And we are far away from that. Yeah? So we are just building steps towards it. In the short run, I think the more systems thinking suggests there are solutions. One, I named it, is the circular economy thinking. I'm a great fan of that. We still have a long way to go, but that is a revolution in its own right. If you can reuse raw material, no longer have to extract, that is big. The second one is obviously the energy transformation to create 100% clean electricity. Would be a major revolution. But even if we achieved both of these fundamentals in terms of technology, it's feasible already. Even if we did that, we would not solve all the big problems because our footprint is so big and our consumption. So I think we also need an adjustment of values. Now, on the finance side, there's one good news. We have moved from what's called active investment to passive investment, where increasingly ESG factors are plugged in. The next phase will be hyper-customized, value-based investment. My firm has already an autonomous machine in the making, and we know others are working on that too. That means people will soon be empowered to express their personal values when they decide, how do I invest my £50 here or my £100 there? Do I want to link it with some sustainability goals or not? So this democratization empowerment is soon within reach. Will people make full use of it? Probably not all of them, but a growing number will. So we are getting there. And social norm changes, in my understanding, are never easy to come by. Usually they happen only when a major shock happens. Yes, some other movements are very fast. Think the Me Too movement, for example. But look at racial issues in this country. It's lingering on, and many other issues, or inequality issues. But once we have a major disruption of some kind, then people are prepared to rethink and to create new values based on the response to the crisis. One would hope that we are more rational, and but we come back to the same dilemma. We are not rational, actually. The myths of the past still define much of our decision-making today.
Yeah. Okay. Thank you for that. We've got a question from Robin. Robin, do you want to ask the question yourself, or shall I ask it on your behalf?
No, I'll ask it. Hi, Georg. It's been
Hi,
Robin. Good to see you. I just wanted to take you back to your previous job, in a way, the Global Compact, which you launched 20 or so years ago, and I think it's been very successful myself. But looking back over that period and sort of looking forward, how do you sort of see that positioned? Obviously, that's trying to switch company thinking over to ESG and all this, but how big a tool, how big a lever is that now, do you think?
Well, Robin, so great to connect with you again, and we will carry forward. Robin has helped me a lot in the foundation of the Global Compact. Your guidance then really was important to me. I treasure that forever, Robin, your wisdom, and many anecdotes that come back. I think we have to be realistic. I think voluntary corporate activities are only one part in the puzzle. By themselves, they cannot solve systems challenges by themselves, left unattended. Even those decarbonization, net zero commitments, which at face value, have a very long lifetime, but even the medium term, they can only work if carbon is priced appropriately. Otherwise, companies would all go bankrupt. It's one simple example that system change can only work if the system itself changes. So whatever one actor, even if very powerful business, it's a step in the right direction. It helps because it lowers the barriers for others. It shows regulators we can move in that direction. It sends also signals to citizens in general. So I think it's a contribution, but by itself is just not sufficient. And that's why some people, when they criticize ESG, they don't get it when they say ESG doesn't solve the world. Of course, it cannot. It's just one player. Also, finance is just one, an important one, but it's only one in a societal change agenda. You need all parts to play in the same direction. And regulators play an important role. Consumer behavior plays an important role. Business, finance, civil society, culture-based organizations, education, and steering that in one direction, that is the challenge. And that is so difficult, and that's why so many of us who have been so active for so many years are sometimes frustrated because we don't see the big impact. We saved the world, or we did this or that. No, but we did at least enable, and we made it easier. It's a contribution in the right direction.
Okay. Thank you for that. We've got another question from Nicola, Georg. I'm not sure whether Nicola wants to ask herself. I think she's unmuting herself. Yes. Hi, Nicola. Do you want to pose your question to Georg?
Yes. Thank you. It's really about the sort of credibility of net zero commitments, and how concerned are you that the company's net zero climate commitments today are very reliant on carbon offsets? And do you think the carbon offset market will actually allow the carbon industries to just continue for longer with business as usual?
I have actually a pretty strong view on the compensation market, on the offset market. I think it should be totally secondary at this point. I think the absolute focus has to be on reductions at the source. And I've been telling a number of companies, don't mix the two together. You cannot buy your clean soul by offsetting. You cannot. You have to reduce. So I'm in line there with many civil society organizations, which doesn't mean that the offset market won't play a role in the future. It has to, and it will, but it needs to have much different standards and much higher standards, and we haven't seen that yet. I'm concerned about many of the commitments made because they're so long into the future. And I think it's really important to call in the near-term goals by in 2 years, in 3 years, in 5 years, by next year. So, and civil society organizations are shifting in that direction. Yeah. And many CEOs, I think, now start to understand that their net zero strategies cannot work if the regulator doesn't play along either, for example, through carbon pricing. So that creates an opportunities for CEOs to advocate for, say, carbon pricing or regulatory changes. So it's a good thing. It puts mindsets in the right track, but the emphasis, I think, should be much more on the near term now, and the evidence has to be delivered in the short run. And this is where companies now are quite nervous because they have to show reductions. If they don't show reductions soon on their emissions, their long-term commitments, the value of that diminishes. The excuse they have now is, of course, the war in Ukraine, in Europe, because that calls for emergency measures. Many companies are beefing up on coal again to keep the energy going, and nobody knows what will happen there. That's why I think this crisis management dimension is so important currently to translate this into the long-term agenda and not just by every short-term measure for the sake of adjustment.
Okay.
My appointment there with politicians is that they want to please the citizens in the short run, and they no longer really tell the true story and ask them for help. I'm sure many people would be willing to make a contribution on energy efficiency measures and conservation if called upon. But politicians have become very short-term too.
Okay, thank you for that, Georg. And the final question is from Lynn, and she asks, recent research in higher education shows that graduates are placing doing good and working in an organization that matches their values at a higher priority than salary and other, let me just finish, and other benefits. Will recruitment issues help the better firms to prosper? sorry, I've got a frog in my mouth. So basically, the younger generation are much more orientated to have a broader perspective in terms of what makes a good company, including environmental factors. And what lessons can we learn from that?
Yes, and that is a very positive development. It's happening already. Young people want to see a purpose in the company for which they're working. They want to understand increasingly what's the role in society, what's the contribution, how is the perception of the company, and the search for talents is increasingly important. As I explained before, in my understanding, labor is no longer a cost factor. The intangible assets and the access to it to attract and retain the right talents increasingly drives the market itself. And that's a good development. I just hope that this trend continues, that it will get even stronger. So absolutely, that's a positive development.
Awesome. Nice.
All right, we lost the moderator. That's okay. I think, is there one more question or not? He said it was the last question, yeah. So with that in mind, I just want to thank you all and appeal to everybody to, for me, it has meant also the recent weeks that peace has always been the highest public good, peace. Yeah? And in peaceful times, we forget about the ugliness of war. We forget about it in our conduct, in our valuations. And the current situation is a reminder to rediscover the importance of peace. Yeah. So I think it's not a big insight. Forgive me for making that point. It's a trivial insight, but maybe a useful one.
Yeah, sorry about that, Georg, but I had a domestic emergency for about 2 minutes, so I apologize for that, but you held the fort valiantly. Thank you for that, Georg. I think that's the questions done now. So before I draw it to conclusion, it would be really helpful if we could all unmute ourselves and give Georg another round of applause for an excellent exposition of ESGs.
Wonderful.
Thank you very much, Georg.
Thank you, Andreas. Thank you.
And just before we go, I'll let people know what's happening next over the next few weeks in terms of the program. As I'm also running the World Affairs program at the moment, I thought you might be interested that next week we have a talk by Professor Rob Wortham from the University of Bath on artificial intelligence's journey. So the past, present, and future of artificial intelligence, which obviously will touch on business-related matters. So if you feel free to dial in for that. The next economics talk is in May by Professor Philip McCann from Sheffield University on levelling up. We've heard a lot about levelling up in the economy between the North and the South. Little has happened so far, and he's going to give a talk in terms of the hows and whens and whys of levelling up. So that'll be an interesting talk in May. And we also have another World Affairs talk, actually very closely related in May to this talk by Georg, which is actually two contributors to the latest International Panel of Climate Change authors are giving a talk on climate change and urgency in May. So that would be another good one. And then in June, we have a talk on the 6 phases of globalization. Again, covering aspects of that Georg mentioned already tonight in terms of globalization and the impact that has on a variety of factors. So that's it. There's plenty to keep us entertained. And as I said at the beginning with Georg, the Chinese curse is with us. We are living in very interesting times. We'll soon see what happens in Europe, not just in Ukraine, but with the French elections and Marine Le Pen coming up on the 24th. The world is changing, that's for sure. But as I always close these meetings, stay healthy, stay safe, and most importantly of all, stay sane. Good night, everybody.
Thank you. Thanks very much.